A preemptive strike is designed to eliminate a military threat, but its most immediate and most measurable casualty is never the target. It is the system built around the target. The supply chains, the insurance markets, the freight corridors, and the defense stockpiles that the entire global economy depends on without ever noticing them. On February 28, 2026, Israeli Air Force aircraft crossed into Iranian airspace in the early morning hours and struck a series of military and strategic targets across the country. The strikes were not a surprise to anyone who had been tracking the diplomatic signals of the previous 3 weeks. A series of compressed timelines, emergency Washington summits, and publicly stated ultimatums had made clear that the diplomatic window was narrowing fast. But knowing a strike is coming and understanding its full economic architecture are two entirely different exercises. This is not an analysis of the military outcome. That will be studied by defense institutions for years. This is an analysis of what happens to the world's logistics, energy markets, and defense industrial balance sheets in the hours, days, and weeks that follow a strike of this scale. Because the economic shock of a preemptive operation in a geography like this one does not wait for the military results to arrive. It begins the moment the first radar goes blank. At 03:47 local time on February 28th, air traffic control systems across the broader Middle Eastern corridor began issuing emergency ground stops. Within 11 minutes, the airspace over Iran, Iraq, Kuwait, and the northern Persian Gulf was declared a conflict zone by 3 separate aviation authorities simultaneously. Airlines operating long-haul routes between Europe and Asia, a corridor that accounts for roughly 30% of global commercial aviation by passenger volume, were now facing a structural obstruction at the exact geographic midpoint of their operations. This is not a new scenario in the playbook of aviation risk managers. The closure of Ukrainian airspace following February 2022 serves as the cleanest modern precedent. When Russian forces began operations across Ukraine's borders, airlines were forced to reroute eastward or northward, adding between 2 and 4 hours to flights connecting Europe with key Asian hubs, including Seoul, Tokyo, Hong Kong, and Singapore. Those reroutes translated into an immediate 18 to 22% increase in fuel burn per affected flight. At current jet fuel prices, that differential compounded across thousands of daily flights represents a cost increase measured not in millions, but in hundreds of millions of dollars per week for the global aviation industry. The February 28th closure is geometrically more severe because the affected airspace sits at a critical meridian. The Middle Eastern corridor functions as the connector between 3 of the world's largest trading blocs: Europe, South Asia, and East Asia. It is not merely a shortcut, it is the structural bridge of global commerce. Carriers are now evaluating routes that swing significantly southward over the Arabian Sea toward India, or northward through Central Asian corridors, neither of which is optimized for the weight loads and fuel reserves of modern wide-body aircraft. The financial exposure for aviation alone, based on the Ukraine rerouting model applied to a higher traffic corridor, likely exceeds $1 billion in incremental costs per month before any demand destruction is factored in. But aviation is only one layer of the disruption. The second and strategically more consequential signal emerged from the marine insurance markets. Within 40 minutes of the first confirmed strike reports crossing Reuters and Bloomberg terminals, Lloyd's of London underwriters began issuing hold orders on new war risk policy issuances for vessels operating in or transiting toward the Persian Gulf. This is a mechanism that most people outside the shipping and energy industries have never heard of, but it is one of the most powerful levers in global trade. War risk premiums are the additional insurance cost that shipping companies must pay beyond standard marine coverage whenever their vessels operate in zones classified as elevated conflict risk. Under normal market conditions, war risk premiums for Persian Gulf transit represent a small fraction of total voyage costs, typically between 0.05 and 0.1% of a vessel's insured value per voyage. Following the Houthi Red Sea disruptions of late 2023 and 2024, the industry witnessed what happens when these premiums are repriced under genuine threat conditions. War risk rates for Red Sea transit increased by a factor of 10 to 15 within a matter of days, and in some cases reached levels that made the voyage economically irrational for smaller operators. The Persian Gulf is a fundamentally different magnitude of exposure. Approximately 21 million barrels of crude oil transit the Strait of Hormuz every single day. That figure represents roughly 20% of total global petroleum consumption. It also represents the export lifeline of Saudi Arabia, Iraq, the UAE, Kuwait, and Qatar simultaneously. When insurers freeze new policy issuances for this corridor, tanker operators face an immediate operational paralysis. A vessel cannot legally sail without valid insurance coverage in most jurisdictions. A vessel cannot obtain financing for its cargo without proof of coverage. The freeze does not need to last weeks to cause damage. It needs only to last days. Historical precedent from the 1980s tanker war, when Iraqi and Iranian forces struck more than 500 commercial vessels in the Gulf over the course of 5 years, demonstrates that even partial insurance disruption raises the cost of moving oil dramatically enough to register in global consumer prices. The more relevant modern parallel is the June 2019 Gulf of Oman tanker incidents, when 2 vessels were attacked near the Strait of Hormuz. Within 48 hours, Brent crude prices rose approximately 4%. War risk premiums for Gulf tanker traffic increased by 50% in the week following. That was a response to 2 incidents involving no confirmed military action between major powers. The February 28 strikes involved the full military apparatus of a nuclear-capable regional power and its strategic partner targeting the military infrastructure of the world's primary oil transit choke point's territorial controller. The repricing of risk in that environment is not linear. It is exponential. Energy analysts, tracking futures markets in the hours following the strikes, observed immediate upward pressure on crude prices, with Brent contracts moving sharply as traders discounted not the current flow of oil, but the probability distribution of future flow disruptions. This is how energy markets always respond to choke point risk events, not by measuring what is currently blocked, but by pricing what might be blocked tomorrow. The third dimension of the geoeconomic fallout from February 28th is perhaps the least reported in real time, but the most structurally consequential for Western defense policy in the medium term. It is what defense economists call the cost exchange ratio, the financial mathematics of interception. When a state launches a preemptive strike, it is buying time against a threat. But it is simultaneously obligating itself to absorb and intercept the retaliation that follows. And retaliation, in the Iranian strategic doctrine developed and refined over the past decade, is not designed to win a conventional military exchange. It is designed to impose costs on the intercepting party that are structurally unsustainable over time. Iran's ballistic missile inventory, even following significant attrition during earlier exchanges, includes weapons produced at a cost range of between $200,000 and $2 million per unit, depending on the system. The Shahab 3 variants that form the bulk of Iran's medium-range arsenal fall toward the lower end of that range. The precision-guided systems developed more recently carry higher unit costs, but remain well below the cost of the systems designed to intercept them. An Arrow 3 interceptor missile, produced jointly by Israel Aerospace Industries and Boeing, carries a unit cost estimated between $2 million and $3.5 million per shot. A Patriot. Advanced Capability 3 Interceptor, the primary terminal defense system in the U.S. inventory, carries a unit cost of approximately $4 million per missile. The cost exchange math requires no economic expertise to evaluate. If Iran fires a salvo of 40 medium-range ballistic missiles at a combined production cost of perhaps $50 million, and the interception requires 40 Patriot missiles at $4 million each, the defending side has just spent $160 million to neutralize a $50 million attack. The exchange ratio runs 3-to-1 against the defender. This is not a theoretical concern. It is a documented pattern that Pentagon planners have tracked since the Houthi missile campaign in the Red Sea began straining U.S. and Allied interceptor inventories. The U.S. Navy fired more Standard Missile 2 and SM-6 interceptors in the Red Sea between October 2023 and mid-2024 than it had fired in combat in the preceding decade, combined. The production rate of these systems, constrained by specialized component supply chains, skilled manufacturing labor, and the physics of solid fuel propellant production, cannot be scaled up quickly. Raytheon, the primary U.S. manufacturer of Patriot interceptors, has publicly stated that increasing production meaningfully requires 24 to 36 months of lead time for factory expansion and supplier qualification. The Israeli defense industry faces parallel constraints. The stockpile of interceptors available for the response phase of a February 28th scenario is therefore a finite resource being drawn down against an adversary whose retaliation capacity, while significantly degraded from its peak, still includes hundreds of functional ballistic systems spread across dispersed and hardened launch sites. The economic pressure this creates on Western defense budgets is not a background concern. It is a primary strategic variable. Every interceptor fired in the coming days is one that will require 24 to 36 months to replace at current production rates. This reality does not change the tactical decisions made in real time. Those decisions are driven by the immediate threat picture. But it means that the fiscal and industrial cost of this operation will continue accumulating long after the kinetic phase subsides. There is a historical parallel that frames this dynamic with particular clarity. During the 1991 Gulf War, the U.S. and coalition forces fired 158 Patriot interceptor missiles over the course of the conflict. The post-war production ramp-up to replenish those stocks was considered a significant logistical undertaking at the time. The current conflict environment, with U.S. and Allied interceptor stocks simultaneously drawn down by commitments in the Red Sea, in Taiwan, strait readiness postures, and now in a Persian Gulf escalation, represents a multiple-front inventory stress of a kind that the Western defense industrial base has not faced since the Cold War's final decade. The broader geoeconomic picture that emerges from these three signals, airspace closure, insurance paralysis, and interceptor economics, is not simply a story about a localized military operation. It is a story about how a tactical decision, made at the intersection of intelligence timelines and political red lines, transmits its costs through every layer of the global economic system simultaneously. The airspace disruption raises costs for aviation, which raises costs for air freight, which delays pharmaceutical shipments and electronics components and perishable goods moving between Asia and Europe. The insurance paralysis slows tanker movements, which tightens crude supply signals, which moves oil futures, which translates within weeks into higher gasoline and heating fuel costs for consumers in economies that never touched a weapon or cast a diplomatic vote. The Interceptor drawdown creates a defense procurement crisis that will shape military budget debates in Washington, Jerusalem, and allied European capitals for the next several years. This is the structural reality of operating military force in a geography that sits at the intersection of the world's most critical energy corridor, its most traveled aviation bridge, and its most watched insurance market. The term surgical strike has always carried an implicit promise that force can be applied precisely enough to isolate the consequences to the intended target. What the February 28th strikes demonstrate, as every operation of this scale demonstrates, is that geography does not allow for surgical isolation, when the operating theater is also the world's logistical spine. The Strait of Hormuz is not simply a military flashpoint. It is the valve through which 1/5 of the world's daily petroleum consumption flows. The airspace above the Persian Gulf is not simply a conflict zone. It is the meridian through which the world's most trafficked long-haul aviation routes pass. And the defense stockpiles now being drawn down in real time are not simply military assets. They are the physical inventory of deterrence, the hardware whose availability or scarcity signals to every regional actor whether Western security commitments are credible or strained. The strategic logic of preemption is always constructed around a forward-looking calculation. Act now to prevent a worse situation later. Whether that calculation proves correct will be debated by strategists and historians. But the economic balance sheet of the decision is already being written in aviation fuel surcharges, in frozen insurance markets, in depleted interceptor magazines, and in the quiet arithmetic of supply chains adapting to a world where the geography they depend on is no longer a stable background condition. That is the cost of preemption that no operational briefing captures, and it will be paid incrementally, diffusely, and over a much longer timeline than the strikes themselves.